Hello and welcome to Asset TV. I'm Erin Real, and today I'm sitting down with Kyle Brown, CEO of Trinity Capital. Kyle, welcome. So Trinity has 5 verticals across private credit. So when investors buy the stock, what exactly are they buying and what are they getting?
Sure. So we are a asset management business, first and foremost. We're structured as a business development company, a BDC. We run 5 different lending businesses, and we're really in the business of building lending businesses. That's what we do. We focus on small to medium-sized businesses, kind of on the cusp of EBITDA, so venture-backed companies that are growing, heading towards some liquidity event like an IPO or a merger, and then kind of post that stage into profitability, PE buyout type transactions. So we focus a lot on technology, a lot of software as a service. We're providing a lot of equipment financing to companies that have CapEx needs. We have a life science and healthcare business focused on kind of post FDA approved product sales. And then we do ABL, so asset-backed lending. We're providing advances against assets that are sitting in SPVs. And then we do a lot of, like I mentioned, PE buyouts. So really focused on growth-oriented businesses, companies growing at a 10 to 100% annual growth rate, backed by private equity. And who are looking for a little bit less dilutive capital to help them accomplish milestones as they build their valuation, heading towards an IPO or a liquidity event. So really focused on kind of check sizes to companies of $20 to $100 million and kind of right around that $1 billion valuation, almost exclusively private companies. So this is really bespoke investments into the private sector. With companies valued at or below $1 billion.
So how does Trinity differentiate itself from other lenders and then other publicly traded business development companies?
Sure. So first, it would be our just corporate structure. So our investors, when you buy Trinity, there is no management fee. There is no incentive fee. So first and foremost, that's a huge differentiator for us. When you buy Trinity, you're actually buying into the management company. We do have over 100 loans and direct investments that you have access to in this diversification. So you have a pool of assets you're investing into and a management company. So biggest differentiator between us and the majority of other BDCs out there is that you get to own the management company. You get to own the business and not just a pool of stagnant assets. So that's the first thing. We are making investments into a really unique space. We're not competing against the upper middle market. You hear a lot about private credit right now. You hear a lot about fundraising for that sector, depressed yields in that sector, compressed yields in that sector. We're a little bit detached from that because we're lending into this lower middle market, $1 billion or less valuation for these companies. And it's a little more niche. And so we have a little bit higher returns historically over 17 years, a little bit higher returns. And so investors get more alpha returns with us compared to the rest of private credit right now. And then the last thing is we're not, in most BDCs, it's stagnant dividend income like other REITs. They're really not focused on building the dividend. We have historically been really focused on building the dividend. And that's because our public company, Trin, when you buy it, trades on the NASDAQ, it owns a management company. That management company goes out and raises money privately and does charge management fees and incentive fees to private investors. 100% of the benefits of that flow to our public company, and it gives us the ability to generate income above and beyond our loans. So that gives us this growth trajectory, and we've been on it for years now, where we're not just providing nice dividends to investors and consistent dividends. We do that, but they're growing over time because we have other sources of income above and beyond just the loans we issue. So when you buy our stock, our goal is to, and has been for some time, to just deliver a consistent and growing dividend over time.
Kyle, how do you expect tariffs to impact Trinity Capital?
So we took a similar approach with tariffs and the announcement of these tariffs as we did during COVID and previous cycles where first and foremost, you got to protect the house, right? And so we have a really concentrated effort on identifying how tariffs would impact each individual company. And we have 15 portfolio managers who dive into our portfolio, contact all 100 plus of our borrowers to identify what that impact is going to be to them. We provide our own sensitization. So first and foremost, it's kind of focusing in on the portfolio. the good news for us is the majority of our companies are U.S. based. We actually do provide a lot of equipment financing, like I mentioned, to companies that are manufacturing goods, but the majority of that's already manufactured in the U.S. and then sold to U.S.-based companies. And so there will be some, if they go through and if they continue to go through, there'll be some impact to cost of goods for these companies, but it's actually relatively minimal so far as we can tell. And so there will be some impact to COGS for some of these companies, which will impact the bottom line a little bit. But so far, we've not seen it impact really any substantial part of our portfolio in any negative way. We provide, and we have been for many years, providing CapEx financing to companies manufacturing in the U.S. And so we've actually seen a pretty big boom as a result of the tariffs within our own portfolio. We saw in Q1 an increase of over 20% on CapEx spend, or at least CapEx plan on spend, and we're right there to finance it. So we have seen an increase in our equipment financing in Q1 that has led into a pretty positive Q2 as well. So tariffs so far have, I'd say, maybe neutral to positive effect on our business because we're really focused on companies that are building things in the U.S.
Now, you kind of just touched on it, but I'd like to expand. What do you think the effects of reshoring manufacturing are going to have, and does it create an opportunity? You kind of mentioned some opportunities there, but do you think it will grow?
Yeah, I think there's a little bit of a misconception, right? Apple's probably not going to make all their iPhones here in the U.S., right? And so Fortune 500 companies may not be the primary candidates for reshoring or manufacturing in the U.S., but there's well over 1 million small businesses that do make things here in the U.S. And a lot of those companies are thinking about or are reshoring in the U.S., particularly VC-backed companies that are in an early stage who have raised $50, $100 million. They are thinking about building here in the U.S. And then there's certain sectors that are focused more on manufacturing here in the U.S. than others. A lot of that's going to be anything in kind of the AI space, right? You have not only just the focus on chip and manufacturing of chips here in the U.S., with some larger companies starting to build out their manufacturing capabilities here. But data centers, we're focused a lot on life science and med device. We're seeing more and more of that built here in the U.S., so that's really interesting. And then frontier tech, I call it frontier tech, but it's really kind of space, anything relative to space. We're seeing more and more manufacturing here in the U.S. for that. It could be satellite components for low orbit satellites, could be manufacturing for rocket development, for deploying those satellites into space. So we're seeing more and more interest and activity for small to medium-sized businesses for manufacturing here in the U.S. So far, I'd say, this year has been a large increase in pickup in activity for CapEx spend here in the U.S.
Let's talk interest rate fluctuations. How do you see this affecting either your deal pipeline or just your economics of Trinity Capital in general?
Yeah, clearly rates dropping as quickly, raising as quickly as they did and then dropping as quickly as they did, there is an impact there. So for our business, though, we have about half of our leverage is floating rate. And so as rates decline, so does the cost of our capital. The majority of our loans that we've issued are actually, they are also floating, but they have floor rates. So we saw some impact to yield decline over the last 6 months as rates have declined, but the majority of our portfolio is sitting at floor rates or close to it at this point. So to the extent we see half a point or 100 basis points reduction in rate, at this point, going forward for our business, it's actually neutral to positive because the cost of our capital decreased faster than the loans that we have issued right now. So we don't see a negative impact because of rate declines in the coming future. It could actually provide some interesting opportunities for some refinances, which then will pull some fees forward. But I'd say the bulk of the impact of rate declines have already impacted our bottom line. And I don't see it negatively impacting us going forward.
Okay, even with Powell saying best case scenario only one this year.
Yeah, I don't know that we necessarily need. This is more of a opinion on kind of the macro sense, but I don't know that we necessarily need rate cuts right now. I understand that rate cuts could spur activity, maybe spur some M&A activity because they need that cost of leverage to be lower for some of these deals to make sense. But I don't know that we need it. So as I think about how it impacts our business, though, it's a really minimal impact at this point going forward.
And Trinity has been able to deliver a 14% dividend yield, and we get this right, for the past 21 consecutive quarters. It's either been 14% or increased on that. So how have you been able to accomplish this?
Yeah, I mean, that sounds great. That really just means the stock is lower than it should be, right? So we've been a public company going on. We listed on the NASDAQ at the beginning of 2021, and there is a process of showing and performing for the market, for institutional and then retail investors. We're still in that process right now. We've been at this for 17 years, but as a public company, we've been at it for just over 4 years. And so I think the market's getting used to what we do. Retail investors and institutional investors alike are starting to see that these guys do what they say they're going to do. And we have slowly seen that yield go down as the stock goes up. So I mentioned it before, we're really focused on keeping the dividend steady and growing it. So in theory, as we continue to increase the dividend, that yield should either go up or it should go down based on the demand of the stock. So I just bought stock last week because I think it's way too low. And so I think over time, we'll probably start to move towards the mean or average of other internally managed BDCs, which is more like 130% of NAV and a much lower or a much higher stock price than where we currently sit today as a result of that. So yeah, it's a great yield, pays quarterly, and investors should be pretty excited about it right now. Yeah.
14 sounds good. So private credit, you mentioned that. Everyone's mentioning it lately. A lot of talk. So what are some of the benefits for exposure for both individual and retail in terms of private credit?
Yeah. Well, I think this is more of a macro comment, but public companies have continued to decrease over the last 10 years. And I think there's just over 5,000 public companies today. There was 10,000, a little over 10 years ago. The companies stay private longer. There's a robust private market now for equity and debt. Private credit has grown at just about the same pace as private companies have grown. So it's really not overblown. It's not oversaturated at this point. The market demands more credit because it has simply grown significantly. And so private credit and companies like ours where you can buy and sell into it, you're getting access to mature at-scale companies that many of which could be publicly traded who have chosen to be and stay private because they have access to capital and they continue to grow. And so, it's an interesting and growing market. I think it has legs. We have another 5 to 10 years, I think, of this really continuing to mature and grow. And private credit offers a really interesting entry point into these companies with a nice return. In many cases, it's high single digits to kind of low teens type current pay returns. And we're sitting in a senior position against these companies that have significant enterprise value, great income, many of which have long lasting and legacy type businesses. And the loan compared to the value of the company is relatively low. And so it's a risk adverse investment that has a nice current pay return, and you have access to deals you just do not have access to through the public market. So I think there's a reason why there's a buzz about it, and that's because there's actually not that many entry points certainly not for public investors, and it's a growing and robust market. So it's been called private credit for 5 years. We've been doing it for a lot longer than that before it was called private credit. But we're excited about the space. We see a ton of growth. We've been growing at a 30+% kind of annual growth rate. We don't see that slowing down right now. And we see more and more companies staying private longer.
Kyle, thank you for your time and your insight. Is there anything else you'd like to add on the subject?
No, I appreciate your time. Thank you for having me.
Thank you. That was Kyle Brown, CEO of Trinity Capital. I'm Erin Real. Thank you for watching Asset TV.